Hello everyone, how's it going? In today's video, we're going to talk about JP Morgan Equity Premium Income ETF trading under the ticker symbol JEPI. When it comes to investing capital in financial markets, individuals often have diverse objectives. Some seek substantial growth in share prices, while others prioritize stable and predictable cash flows. For retail investors who lack the technicals and the financial expertise to pinpoint promising individual stocks, exchange-traded funds offer a much more transparent and accessible solution. So rather than searching for the needle in a haystack, ETFs allow investors to tap into a diversified portfolio without the need for in-depth knowledge of the intricacies of each stock. So one of those equities catering to investors' needs for stable and attractive yields is JEPI, JP Morgan Equity Premium Income ETF. So this fund has been launched back in 2020 and is specifically designed to address the demand for a reliable income source. The primary objective of the ETF is to build a diversified equity portfolio that has been characterized by low volatility and undervaluation compared to the broader market. Notably, the fund is managed by seasoned professionals boasting more than 3 decades of experience, or in fact 6 if you share them between them. So the significance of such funds become apparent when considering portfolios that prioritize stability and diversity in asset exposure. Investors aiming for a balance between risk and return may benefit from JP Morgan's ETF, combining the expertise of experienced fund managers with a focus on constructing a resilient and varied equity portfolio. So, diversification has been a key principle in investment strategy, and it is achieved by spreading the investments across different assets and sectors, reducing the impact of poor performance in any single investment on the overall portfolio. JP Morgan ETF, with its emphasis on constructing a diversified equity portfolio, aligns with this principle. And by investing into a range of equities with varying risk profiles, the fund aims to mitigate the impact of the market volatility, providing investors with a more stable and resilient investment option. The ETF's commitment to low volatility is very appealing for investors who prioritize consistent returns and wish to avoid the turbulence associated with more unpredictable market movements. This emphasis on stability is underscored by the fund's careful selection of undervalued stocks, aiming to provide investors with an opportunity to benefit from potential future price appreciation. Now, before the video continues, if you would like to see more stock analysis like this one, please remember to like, comment, and to subscribe to my channel. So let's delve into the performance of JEPI and examine its price movements over the different time frames. Over the past 5 days, JEPI experienced a modest 0.3% decrease, showcasing a consistent uptrend. Expanding the horizon to the last 30 days would show us a slight decrease of around 0.15%, and over the last 6 months, a marginal dip of 0.14%. In other words, opposite to many other, say, NASDAQ titles, JEPI barely moved over the past 30 days or 6 months. And as we speak, JEPI is trading at around $54.95. And one thing to note is the rebound observed since its lowest point on October 27th, 2023, when it reached $51.50. So following this low, JEPI displayed resilience, bouncing back and hinting at a potential upward trend. Turning our attentions to the management fees, JEPI carries a fee ratio of 0.3, and compared to alternative funds like Schd is much higher, about 5 times more. However, a unique feature of JEPI is its predominantly large cap stock holdings, with no single position exceeding 3%. And this is very impressive amongst market giants, and it really sets JEPI apart. But one of the more intriguing aspects of JEPI is its current yield, ranging between 7% and 9%, which is significantly higher than the likes of Schd, say. So one question arises, why would investors ever consider to invest into JEPI with higher fees and shorter track record since its inception in 2020? I think that the answer really lies in those attractive yields, which serve as a draw to those seeking compelling returns, and sector-wise, JEPI strategically positions itself into consumer staples, healthcare, financials, industrial, and IT. Those sectors are known for their stability and pricing, since the team of JEPI aims to secure positions when prices are favorable while capitalizing on the high dividend yields. In other words, JEPI presents investors with a unique blend of diversification, resilience, and appealing yields. The fees might be relatively higher for investors in pursuit of reliable returns and exposure to proven sectors. JEPI could emerge as a very compelling choice potentially, and the emphasis on diversification, coupled with the ability to rebound from lows and deliver enticing yields, does add to the overall attractiveness of JEPI as a potential investment option. So with that being said, here's a quick look at the technicals. The trading volume of JEPI is around 4.2 million shares versus the average of 3.8 million shares. Over the past 52 weeks, the price fluctuated between $51.38 and $55.94. The volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. If the float is too thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is too limited as well. So, the asset under management of JP Morgan equity premium is around $31 billion. It's lower than SCHD, but still very commendable. As we compare the current price to the historical price fluctuations, the stock is 0.6% higher than the 1-month low, 7% higher than the 3-month low, and 7% higher than the 52-weeks low. On the options market, which often gives a hint on the market sentiment about where the stock could go next, the implied volatility is 7.4%, compared to a historical volatility of 5.3%. The put-call volume ratio is currently at around 230%. Many stocks tend to have a higher put option volume than what they deserve because many institutional investors may hedge their long put. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So, in summary, I do view JEPI as a viable ETF option, serving as a pretty solid alternative to other dividend ETFs and providing a stabilizing presence within a portfolio while offering a comparatively higher yield. Like, the present price could serve as an opportunity to enter, but it's essential to note that the anticipated market volatilities are very low at the moment and may increase in the future. So I would advise caution and reserve some capital to navigate the fluctuations of the market that is ahead. I would recommend to commit between 10 to 15% of your portfolio into JEPI and to split the allocation in batches of 20% over the next 6 months to benefit from any sort of pullbacks or retracements.